Hi, I'm David Witter, founder and CEO of Financial Harvest Wealth Advisors. No new news here. 2016 off to a rough start and has many investors wondering, is a poor start to the year predictive? Meaning, does that help us anticipate future declines here in 2016? So what I thought would be very appropriate is to bring perspective for assessing that. Let me start with this. In 2015, let's get the assertions out there. The S&P was down almost 5%, and it was the ninth worst January since 1926. Furthermore, midway through January, 2 weeks in, almost a negative 8% return here in 2015. That was the worst ever. But let's take a look here. This is a chart that goes all the way back to 1926. The red dots represent the returns for the month of January, and then the blue bars show the returns for February through December, the remainder of that year. So what can we learn from this? First is, believe it or not, 35 out of 90 Januaries were negative. So almost 40% of the time, does January start the year negative. Furthermore, if we look into those 35 years, 21 out of those 35 years ended the year positive despite a negative decline in January. Almost a 60% occurrence. So what that means is, using statistics here, we would anticipate that we have about a 60% chance that the S&P will end the year positive despite having this negative start to January for 2016. Another way of looking at this is if you go back to this recent decline beginning all the way back in November 3rd, which is the previous high, down to January 20th, the S&P is down almost 12%. So the question now is, given this recent decline, what does history tell us about the equity markets going forward? So what I decided to do is go back to 1926. We have 90 years of data, and we polled how many times do we have 10% declines or more. The frequency, believe it or not, was 152 occurrences out of 90 years. That's almost 1.5 or almost 2 per year where we had interim declines of 10% or more. But here's what's fascinating. After those 10% declines, 1 year out compounded returns was 12%, 3 years out was almost 9%, and 5 years out, the average annualized compounded return was 10.1% after a 10% decline. And that on a total return basis is 60% higher after that interim 10% decline on average. Now let's go look at 20% declines. That frequency occurred almost 39 times in 90 years. So almost 1 in 3, or a little bit more than 1 in 3. But a similar story here. If you remain disciplined, 1 year later up 10.5, roughly 7.6, 3 years compounded, and the 5 years still compounded at 9.6, giving a total return of close to 60%. So what do we need to be doing now? First of all, add capital. What we look at is return to the average mean. So when you have negative years or negative time periods, that usually means that the future returns, you have higher expected returns going forward. Secondly, convert traditional IRAs to Roth IRAs. If your traditional IRAs are pre-tax dollars, the values are lower, there's a great opportunity to be converted into a Roth right now. Third is tax loss harvesting. If you have losses in this year, it might be an appropriate time to capture those losses, especially if you're anticipating a gain further out into the year, whether that's in real property or other assets or even your equity portfolios. 4 is know your allocation. Is it appropriate given your time horizon for when you'll need the capital? Some clients have actually talked with me about going a little bit more aggressive now that we've had this recent pullback. And last but not least is rebalance. Remember, you want to, fundamental rule of investing is to sell high and buy low. If you have a portfolio of equities and fixed income has been doing very well recently, had an uptick because of the flight to quality. Maybe it's at a appropriate time to sell out of the high quality fixed income and buy into the equities that have been underperforming. Remain disciplined, know your plan. That's the key to success, and call us if we can help in any way.